Good evening and welcome to Traders Group. Let's get stuck straight into what is a good week fundamentally with the bromance between the North Korean dictator and Mr. Trump, irrespective of the long-term outcome. It's another level of instability that has been removed from the markets. So even if they go down the path of 10 years of negotiation and nothing happens, it's a good thing. So when I look at unstable fundamentals around the world, I'm really struggling to find any. The United States, even the arguments that Trump, as you would have seen, produced with the G7, they're not arguments at all. He's negotiating. I find it very, very strange that politicians react in the way they do to Trump. He's negotiating and they're being offended because they're politicians. So all he's trying to do is to get a better deal. He said that right from the beginning. So that's all good for the US economy. And the US economy is the engine of growth for the world. Therefore, the fundamentals are looking great. The United States has posted, I may have said this last week, but a unemployment rate of 3.8%. Now, from my economic studies, 3.8% is actually full employment. And it is full employment because people are having babies. People can't work because they're retired. They're too old. And you've got people changing jobs. So that is actually a full employment rate. In fact, I think it's the first time in history that they've had such a low employment, and it's going to the point where they're going to have to start importing significant levels of labor, which is a very interesting concept, to support the growth in the US economy if it keeps up. So this is a time of strength, a time of expansion, and it is self-evident in the fact that, as Alan just said, that US equities closed mostly lower after the Federal Reserve raised rates, and they have said they're going to do it twice more this year. You only raise interest rates in periods of strength, but eventually the raising of interest rates increases the cost of capital to companies and chokes off growth. But that's a very long-term lagging thing that occurs. So we're talking 3 to 5 years into the future. Interest rates have an impact on an economy. If an economic growth is too great and you start to get massive increases in inflation, you have to slow the economy down. So the way to slow it down is one of the levers that they have is interest rates. It's monetary policy. So it's all good. There's nothing bad. And the good thing for people in this room, because I think we all fit a mature demographic, is that we should hit our 50s and 60s with a strongly growing global economy, which is good for our retirement funds. So I can't see anything negative on this scene, both technically, fundamentally. Technically, we can see, and we've discussed it in depth, that the market has been supported by a trend line from 2016, has produced an accumulation pattern in the form of a W pattern, has done a V, and then broke to the upside in the last 2 weeks, which is the beginning of a trend. Is that trend going to continue? Well, no, it's not. In the short term, it can't. And the reason it can't is because, technically speaking, the price action, especially yesterday, was too far above its average. And when markets, as we know, get too far above the average, they have the tendency to revert back to the average. So what you'll probably see in the not too distant future will be the market coming back to its moving average, maybe continuing on tonight after that negative bar as of last night. That continuation is important because the depth of the pullback talks to the strength of the market. This is just chart reading 101 to me, but if I look at this particular chart and I'm looking at the range, we've talked about this many times, and this pullback is really shallow. It only comes back to 0.382, the moving average catches up, and then it starts to make a move to the upside. It's an accelerating market. It's a market with increased momentum. If it goes to 0.5, it's totally normal. Goes to 0.6, kind of deep, but normal. If it goes deeper than 0.6, there's a problem. And we've got to watch out because it says it has the potential to fail. So here we are in a strong upward market movement with the expectation of a small counter trend before the next move. I would hope that this pullback doesn't take 2 weeks or maybe 3 weeks. It'd be lovely to be in a big extension as we come into the end of this financial year, but we're going to get what we're going to get what we're going to have, and we can't dictate and force it to occur. And it's been a good year. If you've got some exposure to US dollar and US stocks, the Australian market is not that bad either if you're in the correct sectors. If you are a buy and hold person in Telstra and CBA, you are ready to really be cross with yourself, because it really proves that buy and hold maybe works over a 50-year period, but not in short term. So I don't believe in it at all. So it's a very good picture, basis the markets. In terms of volume behaviour in the past week, basis the S&P 500, although we had a night down last night, overall in the past week, there's been a significant increase in institutional buying behaviour within the past week. When we talk next week, I'll expect to say, oh, it eased a little bit. Well, why did it ease a little bit? Because it's probably going to have a counter trend. So, and that should be to all indexes will back off. In terms of internal numbers, new highs, new lows, this last week, the new highs on the S&P 500 were 5. The new lows, that's wrong. I just read the numbers wrong. Sorry. Starting again. Last week, the new highs were 27 and the new lows were 6. This week, we're reading, the new highs were 32 and the new lows were 6. So in the past 3 weeks, the new high number has been 19, 27, 32. It's expanding. So the internal volume number, the internal new highs, new lows numbers are looking really good. In terms of advancing and declining stocks, advancing stocks were 250, advancing 191, declining. That's a slight decline from last week, because there was 272 advancing last week, 216 declining. Not abnormal, I suppose, if we're having a pullback, which is in progress. What's probably the most important numbers to me is the volume of advancing and the volume of declining. The volume of advancing consistently for the past month is 30% above the volume of declining, and that is an important bullish signal. Other elements to look at that we've talked about 2 or 3 weeks ago, and that was the market is in contango. What does that mean? It means futures in the far months are way higher than futures in the near months. Why is that? Because the futures market is preempting a rising market. That's when a market is in a contango term structure, and we did that 2 or 3 weeks ago. It's a minor point, but it just gives me in my head, it's about, I'm pretty sure or very sure what's happening is actually coming to pass. Okay, just looking at other indices which are very interesting, things like the IWM. IWM has been an extremely strong index and just keeps on breaking into new highs and new lows. New highs every week. But as we can see, as the picture pops up on your screen, it is significantly extended above its moving average and hasn't had a rest for 2 or 3 weeks. So it is due to have a break. So expect all markets, obviously IWM, to back off. In terms of volume behavior, the institutional buying behavior on IWM is significantly higher from last week. But again, if it backs off, it'll be, ebbing away in the next week before it goes again. Some of the laggard countries on the world. So the US, I cannot see anything weak about it. Some of the laggard countries, though, are not Germany, but I just look at the EWG chart, and this is the Exchange Traded Fund representing Germany high cap stocks. It hasn't made a move, but there's a currency effect on that chart. So it's best to look at the DAX. And when I look at the DAX chart, it's extremely bullish when it pops up on your screen. It has had a huge base, put in a beautifully shaped W pattern, has broken or is about to break out of its V once the market gets moving. So there is nothing weak about that pattern. It is a nice big accumulation pattern. And if it doesn't go down any deeper, in fact, it's an accelerating market. It's an accelerating market because the pullback is residing above the previous swing high, which tells me it's kind of strong. If it pulled back deeper, I wouldn't say that, but it's residing above, so it is. DAX is looking real good. One of the, I suppose, not worrying contracts, but laggard economic engines around the planet is the Chinese market. First of all, looking through the eyes of FXI, there is a currency effect on this chart, which is dampening the enthusiasm of its growth, and it's barely trying to break out of this triangle, but it is and will do it. I've mentioned this before, a bit unusual because it's normally highly correlated with metals and mining, and metals and mining is going through the roof. So I can only attribute this to the negotiations between the United States and China. They're refactoring in, trade agreements, and there's a bit of dampened enthusiasm for share buying within the Chinese market. I would have to go research this, but many years ago, I understand that the majority of activity within the Chinese market is driven by retail, and the majority of the activity driven in the United States market is done by wholesale. So it's a very different market. So maybe some of this lack of movement could be attributed to loss of enthusiasm from the general populace rather than the reflection of the economy in China. That would require me to do some pretty deep research, which I don't have the resources all the time. I'm just guessing, but technically speaking, we can see what's happening. It's gone and done a third test of this declining triangle and hasn't broken to the upside. Let's come across to our market. EWA is a disappointment, and in respect that it's struggling to make a move. If you've got a black chart, so have I. I'm just waiting for the upload. Every time I look at when I'm getting the new cable, it's they put it forward another year. I'll get NBN when I'm dead, I suppose. Looking at this EWA, it's doing a very nice trend to the upside, but it's doing it in a very low momentum fashion. The reason it will continue to do that, because a large component of this chart, if you look at the breakup of EWA, is banks. So it's reflecting the horrid position we are within our majors and also within our regional banks, because I looked at them yesterday and they're all collapsing really badly. So we can't expect this particular chart to be too robust. If we come across to XJO, we can see that we've experienced a pullback, which is not abnormal. It's actually totally normal. And it's come back to 0.382, and that 0.382 represents a significant level of former resistance, which is now new support. If I take that out to a monthly chart, I'm sure I've shown you this before, but just in case I haven't. If we take this out to a monthly chart, and I clean up the chart just a little bit, you can see that the 3 arrows on screen represent old resistance, and now the market is sitting on old resistance, which becomes new support. This is very big picture stuff, but a market has what's called memory. I'm not going to go into that at the moment. So it's not unusual that's a logical place for it to occur, and it has. So if we go a little bit into more detail in the current market movement, it kind of looks difficult to see anything of interest because there's so many squiggly lines on screen, and there's so much activity all bunched up together. If it gets like that, the only way you can work out what's happening is to come down a time frame onto a 60-minute chart and see if you can see any patterns that you recognize. When I come down onto a 60-minute chart, I do see something I can recognize. It's a W pattern. If I just rebuild the Fibonacci ratio, I'm going to do a Fibonacci ratio division of range from the lower the pattern to the higher the pattern. Now, let me grab my tool from the lower the pattern to the higher the pattern. And we can see that the market's done a pullback and is residing on a 0.5 pullback. So this pullback that we've had in the last few days is completely normal and probably desirable because it's a normal market. The market could even, come back tomorrow, back to 0.618. It hasn't broken to the upside yet. The trend is still down. It needs to break trend to the upside. So there's still that potential for it to back off. If it continues to back off below 0.618, again, I'm repeating myself from previously, it's a warning signal that the market's about to fail. So it's totally okay. Hopefully she goes up from here. Probably won't because the US is backing off, but we'll see. If it breaks below the previous swing low, that would be the W pattern. Okay, something completely different is happening, but that's a future that hasn't occurred. Let's not make it up. Let's just read the chart as it is. It all looks bullish at this point in time, and there's nothing to be too concerned about. Just put the chart back to a daily chart. So if this is bullish in a big picture, if the US is bullish in the big picture, where's it going to go? It is appropriate, I believe, to now do some forecasting to the upside. If we were doing forecasting to the upside, and the reason I can do that now because we've got a W pattern which is in a confirmed trend. If we do a forecast to the upside, it's appropriate because we've got a base confirmed, and we've done this before. We've done this many times before, and I don't normally do it because it hasn't been the right time. But just as a memory jogger, remember the previous range in the market? Remember we captured the low and the high. I've used the wrong tool. Give me one moment, sorry. Let's get it right. Okay, let me grab the low of the range, the high of the range, mark it up from the low of the pattern. Where's the pattern? There's a W pattern where I marked it up. I'll just mark it up in case you can't see it. There goes the low, there goes the midpoint, there goes the retest, there goes the confirmation, there goes the pullback into flattening to rising 20-period moving average. From that level, which was August low last year, we looked at every point where the market touched a Fibonacci ratio, looking for a top to come in. In all instances, never ever was the indication of institutional selling volume or pattern indicating a high. It was always just a small pullback on every single level. Let me just mark up the pullbacks. There goes the level, there goes the pullback, there goes the level, there goes the pullback. And usually 1.618 is it. And at 1.618, if you remember what happened, market went into a blow off top and managed to hit the 2.618 and fail. That was last year. I'm just reminding you that Fibonacci's are probably a very useful tool. That's all I wanted to point out. So if it worked then, and it's worked 100 times before, why couldn't it work now? Of course it can work now. So let's go and use the chart because we need a range to work it out. What range am I going to use? I'm going to use the range that started in August to the January high. So let me just draw it up for you so you can see it. There goes the low in August. There goes the high in January. Let me grab the whole range. Got to make sure I pick the right tool. Grab the low of the range, grab the high of the range, mark it up from the low of the pattern. And we can clearly see 0.618 is not that level where the market's going to stop. That's the level that it's probably going to hit after this pullback is complete. So maybe at the end of this financial year, we'll be above 0.618. Would be lovely, and maybe even break into a new high. But the logical place to expect resistance in this upward move is 2985 would be the next level. Maybe I'll mark it up on screen and we can refer to it later on, but it's so far off into the distance, it's of no concern at the moment. But where it will become of concern when we get into the seasonal variations of August, September, October. It is not unusual for markets to start going sideways in August, backing off in Sep and falling in October. With October lows, it can be delayed, as we well know. It can be either or. that will be a point of focus. Maybe it isn't the 100. Maybe the market continues on up, doesn't do any indication of distribution. It goes up to 1.618. It's way too far into the future. Too many things could happen between then and now, but that is a logical point on the screen. With Australia, I find it difficult to get too excited about Australia, and increasingly I'm shifting more and more money overseas. With Australia, the problem with Australia is something that we are watching on TV. They've backed off on the stories because they're all so bad. But when the story of Australia, or the bad story of Australia, is written in XXJ, which is the exchange. Sorry, it's not an exchange traded fund. It's the chart that represents finance sector shares minus stocks. And I drew this. This is me just mucking around. This is what I'm expecting to happen. Why am I expecting it to happen? Because the market's accelerating to the downside. And often if you get a inverted head and shoulders pattern, you get a W pattern on the left and a W pattern on the right. There's a beautiful W pattern there. So I started to play around with Richard the other day. Oh, Richard, you're in the room. Richard just popped in. So Richard and I were just looking at this chart. So how far could this go? Seriously, I don't know, but it does kind of look like it's in an extreme capitulation, and the story's probably horrendous. They're not putting them on telly anymore because it's just one bad story after the other. The best thing that could happen is it will capitulate, and it gets to the point that the banking sector is so undervalued that large funds will come in. And it can't be that far off, irrespective of the negative news. Markets are a discounting mechanism. They do discounted cash flow analysis, which are present values of companies. But to do those sort of calculations, you look at the cash flows from the future and you bring them back to the present. That's how you do. These guys do valuation models, and there's a point where it gets to a point where if it coincides with what their model says it should be worth, they'll start to buy. So they can factor in all the negativity in the next, I don't know how far they go out, 5, 10 years. 10 years is a bit far. In the next 5 years, they work out a price based on a valuation model. It hits that level, they will start to buy. And when they start to buy, it'll be, really, really huge. Richard pointed out the other day that CBA at the current price has got a dividend yield of, I think it's going to be 15% or some silly number. Let's just go have a look at CBA, because it's one of the stocks that is everyone's favourite. The problem with CBA at the moment, when I go to a monthly chart, it's the poster child of horrible stocks. This is a monthly chart, and the lines represent, I need to clean up a few of these blue lines. First of all, I would point out that the market was at a significant support level in the past few weeks, and this is a monthly chart. It just broke below. So in the past month, it's trading below a major support line from 2012. This is incredibly weak. Then I would like to point out, using the range from the high, we did this the other day, from the high to the low, and marking that range down by 100, the 100 extension equals $60. That is a logical place for this market to get to. Why is it logical? Because it sits upon old resistance, which will become new support. So I won't be surprised to see this market at least get to $60. And if it slices through $60, who knows? That's a very doable capitulation down to 60. So maybe I'll go back to a daily chart and now draw my fictitious head and shoulders pattern that actually hasn't occurred with a neckline down to $60. This seems too stupid. Can it do it? Sorry, I didn't mean CBA. I was doing that on the XXJ. I'll do it next week, but can this get down to $60? It can do whatever it wants to do and probably will. The stories are pretty negative. we've got the Royal Commission till October in Australia. They're all a bunch of crooks. I'm not happy. I'm in finance, and all as it does is destroy confidence. And as we're all aware that the banks represent a large percentage of our local index within Australia, and it can only dampen any growth. My view is we're in a roaring bull market at the moment, and the banking sector has held it back. Why are we in a roaring bull market? Go look at every sector chart that you can get your hands on, and they're all breaking into new highs. XMM is not a sector, but it's a significant industry. XHJ, new highs. XIJ, new highs. XDJ, new highs. XEJ, energies, new highs nearly. XSJ, consumer, new highs. See what I'm talking about? If it wasn't for the finance sector, we would be going through the roof right now. And all of you guys who are thinking it's all okay, I've got to read some comments. And this includes our New Zealand cousins, Alan. If you've got shares in Australia, you should be angry about these people. Why? Do you think they're not affecting our lives? All their stupidity is impacting on the share prices of the finance sector, which means poor returns within super funds across Australia this year. You can see a direct linkage between their thieving and their stupidity in connection with your returns this year. So should you be angry, you should be livid, and you should demand the people are brought to justice, because I've just got a pet hate for people. The higher you, and I've experienced this, the higher you go up in finance, the less ethics you will find. It's just the way it is, and it's time it was sorted out. So, and everyone is affected. We all are being affected by these criminals. So I'm very, very happy to see convictions and people go to jail. Okay, so just quickly, I'll stop having rave. I'm just getting all carried away there. Sorry, I shouldn't have a personal rave. Okay, so just look at the ones that are on television, like AMP. We hear the stories. Breaking into new lows. WBC, we already saw CBA break into new lows. NAB, Alan just pointed out, NAB is looking okay, breaking into new lows. ANZ, break into new lows. And then I was thinking the regionals in Australia were looking okay. And then I was watching during the week, and then I noticed, BEN, new lows. Bank of Queensland, new lows. Had a bounce today, big deal. I'll just get off the banks for a moment because I pointed this out to you before. Just because the banks are having a bad trot, there are 4 industries of finance. And I made you aware that it doesn't mean all industries are looking bad. In fact, as I pointed out, there are some industries that are fantastic, and those industries are mainly, or the stocks are mainly residing in the diversified financials. And I have had financial exposure in a horrible sector, but in a good industry. And I've made this point before, that there's some really good stocks out there that are going through the roof as long as they're going nowhere near to banks. And that is true for the United States market for some bizarre reason. And I've showed you this 2 weeks ago, so I don't need to recover stuff. Brian's telling me to take a deep breath. Thank you, Brian. I will. Okay. Alan. I can't make a comment. Alan said something that, Alan, you cannot take what I'm saying as specific advice. Here's my disclaimer. Please go seek professional advice before taking action on anything I say this evening. And Alan, someone like yourself, we've been talking about this for days, weeks, and months. It's not something new. So we're coming to the bottom of all the bad news. It's not the time to take action. The time to take action was 6 months ago or more. Okay, totally off track. Let's get stuck into something which is of more interest, and that is the strength of sectors within the markets. This is important because we need to position within the markets for maximum growth. And I have been progressively, I call it trimming my portfolio to take advantage of growth within the United States. In fact, this week I exited out of all my industrial stock exposure, and I reallocated that money to the strongest sectors in the market. So as time moves forward, I don't buy and hold. I slightly adjust the direction and the weightings of what I'm doing. So I may start off in April with a very broad-based, very broadly structured portfolio. But as time goes on and some sectors prove that they are not worthy of holding on to, I'll shed and shift. And the shed and shift at this point in time, or last week, I shed XLI for good reason on this chart, and I couldn't, and I tried to find a particular, even though you can get a weak sector, as I've said, you can get a strong industry, I couldn't find it. I thought it was aerospace and defense, but then the bromance between North Korea and the States has put paid to that, so that didn't work out. So anyway, I've shifted anything over to tech and consumer discretionary. Tech, consumer discretionary, metals and mining as a division of materials is the place that's the strongest engines for growth in the current US market at this point in time. There will be opportunities I believe, in healthcare in the very near future. But just as we stand here today, that's where the action is. And it's also obviously has been in energies, but Bill's just asking me, XLE looks strong, but I'm not totally convinced. I've got to put my head down. Just give me one moment. I'm looking at numbers. One sec. XLE. The reason I'm not super excited about XLE, let me get up a chart. I can see it has been a fantastic sector, and I can see that USO has been fantastic, but this is what I'm looking at on the chart. And I told you I didn't engage in either, and I think I did the right thing. Of course, if I had jumped in and out, it would have been a good thing, but I've only got so much money to allocate. This is why. When I look at XLE, it has broken trend, and it's the first signal for distribution, is it not? Now, all that chart has to do is fall one more time, and there's going to be an M top on screen. Even if it's a three-wave structure in the form of a pullback in the form of a three-wave structure, which I've never taught, just give me one moment, but I have mentioned, the three-wave structure is this. And then it can potentially take off or fail, okay? The point is, volume tells me that's probably what's going to happen. So I can't get excited about jumping into energies in the past month because institutional buying volume has been dissipating, and that would be a true statement when I look at the oil contract. So both technically and potentially volume behavior is telling me that this may not be the place to be in the near future, and there's a lot more, much more exciting things that I could be doing. And I believe I've mentioned this for at least 2 to 3 weeks. And this is USO, which has done a significant move to the downside, has broken 2 trend lines, has volume dissipated and evaporated, and also is having a little rally. Now, if that little rally fails, it's cactus for the short term. So I think I've made the right decision. I didn't jump in February or April, but it looks like it may have failed already, this bullishness, which is great. Who wants to pay $1.60 at the Bowser for fuel each day? So I think the chart, you got to be careful. When you look at the markets, you've got to look at the markets in a complete picture. Just you look at this chart and it says, oh, it's strong. Yeah, great. It is strong, but you've got to go look at other elements. And probably the best element is to go look at the price action. And the price action tells you that this is strong, has been strong, but I would forecast it to maybe get extremely weak. That would be completely different if we looked at something like XLY. XLY, what is it doing? Something that I've pointed out to you many times. It's doing a right rotation on the right of screen. XLY, I'm going to predict, is the strongest sector coming up. Let's go have a look at a chart of that, just out of interest. XLY is going gangbusters. So that's a completely different story to XLE. So this is broken into a new high. It is extremely overbought above its moving average, and it definitely will come back to that average. And that is an opportunity because it is doing a right rotation. This is the beginning, not the end, the beginning of a big move. So those two sectors, along with metals and mining, are the engines of growth in the US market at this point in time. Just give me one moment. I'm just reading the comments that are put in. Okay, Alan was just saying that XLE, I'll just come back to XLE, looks like a head and shoulders pattern. Just let me go back and have a look. Sometimes I'm so busy talking, I don't stop long enough to look at things. Oh yeah, I see what he says. Yeah, you're right, Alan. It's an ugly looking one. Yeah, but this is what Alan's saying. The top always obviously has to be the head. Then you've got to have a left shoulder. It's a very, if it is a head and shoulders pattern, it's very unsymmetrical. I don't think that's the best description for it. The best description would be, if it does fail, it's going to be a perfect M top, would be probably the better description, but it doesn't really matter. They're all the same patterns within patterns. It's all good. Okay, let me just go down to, I think we've done energies and we've done the US market. Let me go across to the Australian market. The Australian market has some really strong elements to it. I just went through the Australian market. I showed you every sector looks like it's punching into new highs, except obviously finance. Some of the really big movers at the moment has been healthcare. Healthcare is the driver, one of the big drivers of the Australian market at the moment. XMM, metals and mining, say no more. XMM is material sector plus, packaging and all the things connected to the material sector. So it's not just metals and mining. Material sector stocks are looking good. XIJ is doing what? A right rotation. What does that say? Lots of strength coming up. XDJ looking really good. XXJ, look, it's had a bit of a loss of momentum. That just indicates a pullback. It is still a strong sector. So why is the Australian market so different to the US? In the US, there's three primary sectors which are causing the growth. In Australia, it's very broad-based. It's nearly everything. It's every sector. It's a very broad-based growth picture here. With only finance and telecoms being the horrible sectors in the market. Usually utilities is defensive, so that means if we're going up, utilities is not the thing to invest in, but everything else is. So I am invested in a broad base of Australian stocks, and it's all looking good. Let's come across to the currency market, and Mike, I just saw. Okay, Brian, I've just got a few questions to answer before I go too quick. Okay, let me come across to Brian's question, which is XLY. Brian's question is, are you expecting a pullback to the MA? And the answer is absolutely. And the reason is, Brian, when markets extend too far above that blue line called a 20-period exponential moving average, they have a high tendency to revert. Why? Because markets don't move at such a rate of change in price. They do a natural, roughly a 45-degree move up the screen, depending on your scaling, and that is just a blow off. Therefore, it will come back in the short term. There should be numerous examples of this on screen, and there are. So just let's look at the screen. So here, market's gone too far above its average. What did it do next? Here, market's way far above its average. What's it done? Here, way far above its average. What did it do? Way far above its average. What did it do? So it's just a standard thing that you can see to preempt a move. And if you were in a stock and you saw that, it could be the opportunity to ramp up your stop loss underneath the previous day's low or take profits from a specific trade, if that's the reason for the question. Okay, Mike's talking about solar. I'll get onto that in a moment. And Brian, to add to his question, he said, would the choppiness index be of any assistance here? Well, I haven't looked at the choppiness index, but let's go have a look. The choppiness index, when it's really low, says that the market's going to stall. The choppiness index, when it's really high, says the market's going to break out. So the choppiness index is at a point where it is saying the market is about to stall, and we could do a line on the screen just to illustrate the point. So can we see this? Choppiness index is at a low, market's coming up, and it stalls a week later. It's not a timing tool, but it is a tool that tells you that the market's too far gone, and you're quite right. It is predisposed to having a fall. I didn't need the choppiness index to tell me that though. Oh, Alan's just put in another suggestion. Could we use a Bollinger Band, which would also give you a mathematical take on the distribution of price? Now, of course, it's another tool. And all these tools, we've used for 1,000 years. Not really. Feels like 1,000 years, but it is dramatically above, it's been dramatically tracking up. I actually, on this, because it's been going up so hard, I would like to convert to a weekly chart. So I want to have a look at a weekly Bollinger Band. And in the context of a weekly Bollinger Band, it is at that point where it's mathematically at its extreme and has a high tendency to revert back to its average and go back to the bottom band. So yes, all those bits of information all agree that the market should back off. Okay, let me just do some work on currencies and I'll shift across to specific stocks. Just give me one moment. Okay, first of all, I just want to check out FXA. It's going to go across to the correct screen. I've got too many screens here. And I'm on FXA, the Exchange Traded Fund representing the Australian dollar. I need to convert it to a weekly chart because we've done this many times before. And we can observe it's been in a very low momentum channel to the upside with a recent break out of that channel. The question is that break a counter trend and a failure, or is it a low? My increasing view of the Australian dollar is it's a counter trend for a failure because the volume picture has dissipated in the past week and the market's gone down. So I would not be surprised next week to see this on its next leg down. For that to be confirmed, we'd need the opposite to be happening in the US dollar index or the US dollar versus ASX chart traded on the exchange. And it's not totally clear just yet, but I would anticipate for that to occur that this particular market has finished its pullback and continues to the upside. The volume is supporting that. Actually, that's not true. The volume is not supporting that on my information. Therefore, I'm not committed. It's really clear on the Australian chart, but not clear on the I'm getting volume information from the US dollar index and UUP, which is a exchange traded fund. So it's not absolutely clear. But next week, if I see positive numbers popping up, that'll demonstrate support. All as I've got is a 3-day or 4-day upward move. So if the US dollar is breaking up, if the Australian dollar is breaking down, the pseudo currency called gold is going to go where? Is it going to go up or down? It should go down. At this point in time, gold, as we know, is also one of these instruments that's been in this long-term upward trend on a weekly chart, and it's sitting on the bottom of its trend line when it pops up on screen. That base that's been 1, 2, 3, 4 weeks tracking sideways, we go down to a daily chart, and on that daily chart, what do we see? We don't see anything. We just see a test and a retest. There is no accumulation there. The average is pointing down. What's my best guess? My best guess is about to fail. And it's about to fail because the volume, and from last week, this week, the volume behavior has gone negative. Therefore, it tells me, or doesn't tell me, it's not 100%. It says that's the most probable outcome. So the Australian dollar down, gold down, and we could go and look at every other currency and it'd be of a similar picture. Okay, let's go have a look at some specific opportunities and stocks. The first one I want to do is Mike told us about those solar stocks weeks ago, and I'm pretty sure I kept them on my screen because I wanted to watch them. I didn't buy them because I'm fully committed. I've got no more money. Okay, here they are. So here they are, RUN, R-U-N. Oh, see, look at this. Mike. So anyone that listened to Mike and bought this particular stock, so I drew that picture when we first talked about them, and my comments would have been that this is a really strong, high momentum stock because the pullbacks are residing above the previous swing highs. Guess what happened? She took off. So it's gone from $11 to $13. Awesome. ENPH. It's just taking a while to come up. ENPH has done a deep pullback, but that pullback did not break the previous swing low. So it is still in an uptrend with this rather large gap last night. So it is an upward moving stock, but it is much lower momentum than obviously RUN. While we're on energies, this is alternates, but while we're on energies, someone asked me last week about natural gas, and I said I can't just do it on the fly, but I did do something with it. So let me just pull up natural gas. That is the exchange traded fund that represents natural gas. I had a really good look at it. And remember Alan was showing us, my drawing is really bad, but Alan in the past has showed us cup and saucer patterns. This is a very crude, it's not crude, it's lovely. It's a lovely cup and saucer pattern. This cup and saucer pattern from an institutional volume perspective is very well supported by increasing and rising institutional buying behavior. Therefore, I could dig around and look at specific natural gas stocks, which I'll do next week. I only just did this before I logged in. Just have to write in my pad, look at stocks. And as a industry within the energy complex, it could be one of those that resist the overall trend of the sector. But this is looking strong, pattern strong, volume strong. It's looking sweet. Okay. Other specific charts that we looked at, I think I only gave these to you last week, but I just gave you the top 5 tech stocks and the top 5 consumer discretionary stocks that I could get my hands on in terms of momentum, and I'll track them for a few months. So they haven't had time to move yet. So there was GDDY, SPLK, hasn't broken out, but you know, we've seen this pattern only a few weeks ago. Do you remember we saw this pattern only a few weeks ago? Do you remember what the stock was? Netflix. And what happened to Netflix? She took off. FTNT. It's had a rather nice move in the past week. $60 to $64. Can't complain. INTC has had a pullback, but still at a strong uptrend. MA still in a strong uptrend, a little bit of a pullback. ADBE having a nice break to the upside. In terms of the consumer discretionary stocks, it hasn't broken out, but looking good. GRUB, very nice break in the last 5 days from 104 to 115. I own that stock. Netflix, definitely own this stock. Had this since the April low, and fantastic. Even since last week, it's had a really nice break. Problem with this stock, it's so damn expensive. It means the options are expensive, but you can trade spreads. CVNA, holy moly. 1, 2, 3, 4, 5. Okay. This is a pretty nice break, but, I think when I showed it to you, it already had broken. And what is it? It's too far extended above its average to get interested in it, because what's going to happen? It's going to be exactly like this, Brian, and exactly like that. This is going to be a great trade when it comes back to its moving average. I think I have covered all the stocks that we've been tracking. And I just need to just check the message board. I think I covered everyone's questions. For those people that are doing SPY spreads, diagonal spreads, Bill, I sent you a message on your trading platform. Just got to send me a picture, show me what's going on. But they all look good, and there's been some really, really good trades in the past 4 weeks. It's been about 2, I think, maybe 3 trades, I can't remember. Been a bit busy, and that's all looking good. Anyone that wants to get involved in diagonal spread trading, you need to do a course to do that. So just speak to me. I think I'm almost complete for this evening, but I just want to mention that a friend of mine passed away in the last few days, and he was a friend and colleague, and you may know him. That's why I'm telling you. His name was Jim Graham, and Jim was the CEO of OptionView in Chicago, and I've been working with Jim for 20 years. So it is difficult that I can't be over with his family at this time. But the reason I'm telling you is Jim got the flu, then he got pneumonia, and then he died within a week. Bill's just typing in, he had lots of conversations with him. So I urge you guys, if you're getting to that age, you don't think a flu can knock you over. This guy was 56. He's a young man, the hub of OptionView, and I can assure you it's not a very happy office in Chicago. So I'm just thought I'd tell you, because a lot of you may have spoken to him, and people will type in, yep, I've spoken to Jim. And so anyway, that's it. On a really sad note, that's it for this evening. Thanks, guys. Stay safe, and I look forward to seeing you same time next week. Good night.